Happy Mother's Day, and welcome to another episode of the Compounder's Corner. In this video, we'll be going over the companies reporting their earnings this week, and we'll be talking about the stock market in general. And before we hop into the podcast, do you remember how last week I was like, dude, it's so freaking difficult for me to focus right now? Well, turns out it wasn't because of my ADHD or because I was being lazy. It was because I caught some seasonal illness. And right after that podcast recording, dude, I was sick as a dog. And today's the first day where I just feel like I can breathe again. I just feel like myself. And so with that, I had an epiphany. You know what's crazy to me? As a value investor, I'm so freaking obsessed with buying into a great business at an even better price. But this weekend, I don't know what it is. Maybe it's because I was just recovering and sitting around more often than usual. I realized cost basis of how much you bought into something at what price it is doesn't really matter if you do not plan on selling. Now, of course, this only works for an income investment that provides cash flow if you don't really care about the share price appreciation. If it's only growth with no dividend and that investment goes into the red, then you get absolutely nothing. When you look at your portfolio and it's negative 40%, you are negative 40%. But if we're talking about SCHD or a BDC or a REIT that's in the red, you're still going to get a paycheck as long as it's high quality. And I suppose that's a lesson that I'm going to take to heart when I transform this portfolio, the cheese public portfolio, into an income one when I get closer to retirement. As of right now, that's not the name of the game. But do keep in mind, to an income-focused investor, the CAGR is not the name of the game for them. So they don't care or mind if their stocks, ETFs, if it underperforms the market. As long as they get their 4% or 10% dividend yield or payout or income cash flow, whatever it is, that's what they're looking for, that consistency and the dividend growth rate. But anyways, I just thought I would throw that out there because I feel like I hyper-focus on trying to buy high-quality businesses at a really good price, meaning when they're going on a sell-off or when there's a discount or a margin of safety baked in. I just care about my cost basis. But in the grand scheme of things, I guess if the exit plan is non-existent, I guess it doesn't really matter. But anyways, in case you missed it, some videos that were uploaded onto the channel in the past week. Obviously, as I alluded to, I was sick. So I was not productive once again. I'm super busy these days raising my first baby. It's Happy Mother's Day, but I guess Happy Father's Day is coming up. So I only uploaded one video, and it's essentially, the topic is disregarding your future and avoiding the stock market in the present tense because retirement is not guaranteed. And of course, right there, that was sarcasm because I don't agree with that sentiment at all. Because I actually know quite a few people that are very book smart. Like on paper, they have the highest prestigious titles. They have status. The name of their undergrad is like a top 10 school. And yet they're living paycheck to paycheck while earning $150,000, $220,000 a year because they do not care at all about saving, investing. They don't care about any of that. Anyways, watch that video. And yeah, so on a high level, here are the biggest takeaways from this week's earnings. Number one, the AI bubble goes on with Applied Materials reporting. And dude, I'm going to tell you right now, Lam Research, they crushed. ASML, they crushed. So I think Applied Materials, which is a semiconductor equipment manufacturer, I think they're going to crush, okay? And then we also have the B2B giant Cisco. I just sold out of them after holding on for 4 years because I feel like they're just way overvalued. And yes, to me, they were the physical infrastructure to the AI data center play. But at $91, $92, $93 a share, I think they're overvalued. Now, I could be wrong, but yeah. And then number two, we have the international Mag 7 names like Alibaba. We have JD.com, C Limited, which is the Singaporean Amazon, and New Holdings. which is the Latin American SoFi. And then number 3, we have SaaS operations like Monday.com, which, by the way, Atlassian, ticker symbol team, they just reported recently, and they crushed. So their stock price for the past 5 days or past few weeks, dude, it's soaring to the sky. And of course, we have Figma and Wix. And this graphic that you see on your screen right now, if you can't see it, it says on Friday that Alaska Airlines is reporting, which, by the way, they reported their earnings a couple weeks ago, so it's not true. However, on the topic of Alaska Airlines, they made me think of the new highly contagious Hanta virus that's making the rounds on the news. Yes, even here in Japan, we're getting notified about it. And apparently, from what I saw, obviously it could be wrong depending on who your source of truth is. But once you catch it, it has a 40% fatality rate. So apparently, it's a lot worse than COVID. So first and foremost, I don't want to talk just about the business. I want to say this. As a priority, my heart goes out to all of the affected and their loved ones, especially those that were on the cruise ship, because I can only imagine the emotions that are going through their heads, especially with oh my gosh, if I have it, I'm pretty doomed. A 40%, right? That's pretty high. When we talk about some rare cancers of 4% rate or a 3% rate, that's enough to send everything crumbling down and for everyone to be crying. But when we say 40%, I mean, I'm not a betting man, but I don't really like those odds. But anyways, on one of my dog walks this week, here's where my head's at. I think if this turns into another COVID situation, do you remember March of 2020, April 2020? We all thought, oh, it'll be over within a few days. Or at least that's what I thought initially. Yeah, how stupid am I, right? I literally worked at one of the biggest pharmaceutical companies in the world as a strategy leader. And even I thought it would be over within a week. But turned out, dude, the pandemic and COVID and the ramifications afterwards, it was huge. Especially the supply chain issues that occurred. So if Hanta virus evolves into something like that, I'm not trying to be a doomsday kind of a guy, but I'm already thinking ahead of okay, if I was invested into any cruise line stocks like Carnival, Norwegian, any airline stocks, that's why I'm talking about this, because Alaska Airlines, Delta, or hotel stocks. I do like hotel stocks, but man, they do have that seasonality and cyclicality baked in, especially with economic downturns. Or in this case, if there's a pandemic, a highly contagious virus that shuts down traveling and people cannot leave their homes, or they don't even want to go on leisure travels anymore, yeah, those hotels are going to suffer. I would look to sell. I know, it's crazy, right? I'm saying that as the airline stocks are at their 1-year highs. I think the cruise line stocks are thriving as well for the time being. I would sell. I would pivot that capital into the ones that were the winners last time around, like Clorox, Ecolab, or maybe even setting aside my usual hesitation around pharma stocks. You guys know I will never want to invest into pharmaceuticals because it's such a gamble. The R&D, drug pipeline, the marketing, just everything associated with my former industry is such a gamble. But if Hanta virus does play out, right? Here's the thing. I think Eli Lilly and Novo Nordisk, they allocated all of their resources and all of their R&D to weight loss research, right? Because I've been tuning into their earnings. I've been paying attention. They're not even trying to figure out or play around with anything else. That's all they care about. They're doubling down. But when we think about the biggest names coming up with vaccines for viruses, I think Pfizer, Moderna, J&J, I think that could be the play. I could be wrong, but that's where my head is at. So immediately after this podcast, yes, I'm going to be looking up Pfizer's R&D pipeline to see how much of their money is being allocated to this and that, to see if they do have some capital allocation that can go towards the hantavirus or J&J. I think right now the biggest players are the ones that are probably going to be first and foremost to figure out a solution to the hantavirus, because based on my preliminary findings, there is no cure, nor is there a vaccine. So I think whoever comes out with it first, they're going to be the biggest winner. We can also throw in Merck into that conversation. But anyways, there's so much more that I want to talk about. So let's go ahead and look at each day of the week. And yeah, kicking things off on Monday. By the way, I'm on a website called stockanalysis.com. If you use my referral link in the video description, you'll get 10% off if you want to use this website. But anyways, Monday, we've got some Brazilian oil and gas, we got Constellation Energy, and then there's Simon Property Group. Listen, I think prior to the pandemic, I would categorize them as an S-tier REIT. But I think once we learned what happens to real estate, especially during a shutdown, especially when the government mandates that businesses shut down, it kind of changed my opinion about their moat. Let me back it up a bit. Not everyone knows what Simon Property Group is. It's a commercial real estate REIT for all of the various outlet, premium malls, and of course, shopping centers. And I think there's a few apartment complexes in their portfolio as well. So it's pretty high quality, but then again, as you can see, it depends on foot traffic of people going out and about in travel or shopping in person. So if you can't go to the mall, obviously it's going to hurt their business, right? And on the topic of real estate, my first introduction to investing was actually in 2005. Some of you watching this or listening to this, you've probably already know what I'm about to say because you watched my live video that I uploaded like a year and a half, 2 years ago. But anyways, my introduction to investing was in 2005 with the book Rich Dad, Poor Dad. And that book, it really opened my eyes about the whole concept of making money with money, but also not being scared of loans and debt and being leveraged as long as you utilize it, that margin, in a way that's safe. Obviously, you can use margin or loans with a casino mindset, like all or nothing, and then be in a very sticky situation. But if you're smart about it, I don't see loans and debt as that bad of a thing, right? I think those of you with a high net worth, you understand. You got to spend money to make money, and sometimes that involves a lot of debt. But anyways, I always think about if I made the right choices. Obviously, I did not. There's a lot of regrets in my life, but I don't dwell on it because I think that's one of the worst things you can do as a man is to always be contemplating the choices you made, the paths that you took or didn't take, because then you start neglecting and you start to not appreciate what's happening in the present tense and those that are around you right now, and you take things for granted. So yeah, I made a lot of mistakes. But anyways, if I were to do it all over again, would I pick stocks instead of buying physical buildings and being a landlord? I think that's a pretty deep question, right? Because think about it. With real estate, you put down, I don't know, 20%, right? To control 100% of the asset, to get that mortgage, to own that property. Even though it's owned by the bank, it's still under your name as well. So when the property value ticks up by 10%, if you look at the math, your personal investment jumps up by 50%. So essentially, you're getting paid on the bank's money. Even though you're leveraged, you're making a crap ton of money. So I think if you have a lot of capital and you want to make a lot of money, I think physical real estate investing is still the best bang for your buck, in my opinion. Which is why sometimes a mortgage and home ownership, it makes sense, especially if the neighborhood appreciates. No, I'm not talking about Baltimore. Speaking of which, if you buy property in Baltimore or Pittsburgh, dude, it's probably had the same value that it did in 1999 or 2007. The home valuations in that Rust Belt area, it just does not move. So me personally, I would not want to buy property there, but that's neither here nor there. Then, of course, with real estate, it's not all rainbows and sunshines, right? Because there's a ton of stuff you have to deal with. But there's also tax write-offs and depreciation expenses. So, thinking about it, when I was a young military officer, I had the opportunity to buy real estate in El Paso, Texas. And at the time, I know that's going to give away my age, but at the time, homes around me near the base, it was like $55,000 to $65,000 for the good side of town. And at the time, I was making a decent salary, and I didn't buy. There was a lot going on in my life, so I was just like, nah, no. Then again, you fast forward to 2026, I think I'm pretty happy with how things panned out, and especially with my stocks, because with dividend growth investing, I don't have to deal with tenants. Like nightmare tenants where when you evaluate them up front, they shake your hand, they look like a good family, stable credit score. But then by the time you have to put your foot down, get an eviction notice out because they're not paying their rent, and they trash your entire house on their way out and they don't give a crap, I don't have to deal with that. I don't have to deal with repairs or have my capital tied up in a $500,000 property. Because you look at home valuations in 2026, I think it's really hard to buy a decent home under, what would you say, like 300 grand? Now, when I say 500,000, I'm talking about places like Washington State, Oregon State, the Pacific Northwest. Now, obviously, if you're operating with the mindset of like Alabama, South Carolina, I think you can buy a good home for what, like 220, maybe like 250,000. But I think the point still stands. It's a lot of capital that's going to be tied up to that property. Now, on the other hand, I do think a good portfolio or a good asset mix would be a balance of both. Some physical properties that are generating cash flow for you, and then also some stocks. However, I will say this, in retirement, I don't think I would want to mess around being a landlord. So maybe real estate investing is a young man's game. I mean, I could be wrong when I say that. I don't know. I'm just yapping over here, right? It's something that I always thought about doing. And I remember when I was recruiting for various roles during my MBA, chapter in my book of life, real estate is one side that I was heavily contemplating, but I didn't go down that path, which, by the way, one of the best, pivots you can make by going to business school is LDPs. I am not exaggerating when I say that. I think everyone who goes to get their MBA from a top program, you want to go into banking, consulting, or even be a product manager, sure, alongside with 80% of the other MBA kids. But for me, I think with my military background, I was laser focused on LDPs, which are leadership development programs. It's basically like an expedited pipeline to move you up the ranks in a company. So it's a lot more difficult in recruiting because the interview and the vetting process is so much more strict. Because they're not just hiring you to be a manager. They're hiring you to be the next future executive of the company, right? In a VP or executive VP role. And so that's what I did. And I loved it. And I think that's why when I rotated around the various lines of the business, my most favorite was strategy. And that's why sometimes I also say I had exposure to supply chain, which I did, which was fine. It wasn't my most favorite thing in the world, but seeing the operations of how the company makes business and how they make money was pretty cool. But for me, I was more interested in the strategy side of how, what markets we should enter, future M&As, our message, our marketing themes, stuff like that was more fascinating. But anyways, going back to Monday, Simon Property Group, regardless of what happens, I'm not going to be too interested. And then there's also Fox Corporation, which, by the way, they used to air UFC fights up until 2018. One of my good buddies from college, he used to be a UFC fighter. I think he retired now. Because I think with UFC, you quickly find out like whether or not you can make a living from it. Like if your record, your wins and losses, if you tally up more losses, obviously the UFC is not going to renew your contract, right? Speaking of which, Strickland just beat Kamzat. So by the time you listen or watch this video, I think that's pretty crazy. Now, I don't bet. I'm truthful when I say that. I do not do sports gambling. But the odds were stacked against Strickland. I think nobody expected him to win. Because Kamzat, coming into this, he was undefeated, right? He's the champion. He had the belt. And Strickland, he's all over the place. Sometimes he wins, sometimes he loses. But he came out on top. It's one of those things where, I'm not going to lie to you, I'm not rooting for either one of them. But I was like, I kind of feel like Strickland might win this thing. And so had I thrown down like $100, I think I would have made a pretty good profit there. But anyways, it was a wild fight. So there's Fox and anybody else. There's Hims and Hers Health, which they are just soaring to the sky right now because of the continued GLP-1 weight loss Ozempic boom, which I was doing some market research this morning. 1 out of 8 Americans are actively consuming a GLP-1 products right now. Now, obviously, everyone knows, especially if you're tuning in from Asia or Europe, Americans were pretty fat. Okay, I think like 48% of us are obese, which is kind of weird because I live in Japan and almost everyone here is super skinny. It's got to be a genetic metabolism thing because they eat a lot here as well, a ton of carbs. But as Americans, I just feel like also genetics could be be at blame because they also eat a lot, but they store the fat, especially around their waist and thighs and whatnot. So it doesn't surprise me that 1 out of 8 people. And as a matter of fact, I feel like going forward, it might even be prescribed for a bigger percentage of the population because we're finding out that GLP-1 drugs are not just for weight loss. Addiction, drug use, especially alcoholism. I mean, it makes sense, right? If it curbs your appetite and your tendency to just munch on snacks or savory, greasy foods, if it can make you stop doing that, I think it makes all the sense in the world that it can also make you stop doing any other addictive behavior. So I think in therapy, it's going to be utilized a lot. So when I think about the market potential for Ozempic, I don't think the hype is a bubble when it comes to Eli Lilly. I think the reason why they're blowing up, I'm not going to say it's early, because obviously they've already skyrocketed. And even Novo Nordisk, after reaching their 1-year low of like $34, $35, now they're almost $45, $46. They're not the number one, but I think they're number 2. Eli Lilly right now almost has 60% of the market share, but Novo Nordisk is a clear number 2. And it also helps with some other things, right? Like when you think about OCD or people that have eating disorders, like binge eating or not eating. It also helps with like liver and kidney diseases and some other inflammation stuff. So Hims and Hers Health, to be honest with you, I kind of regret not buying into them. I was eyeballing them for the longest time, and I kept thinking like, if their only path to success is making the generic off-brand GLP-1 drugs, which the government allowed because there was a shortage, but now they're not allowed to do it. But then come to find out, Novo Nordisk wants to partner with them, and then their stock price recovered. And I'm thinking to myself, like, why did I not jump in? So it's one of those things where you live and you learn. But also on Monday, we've got Mara Holdings. I think it's a crypto mining service. There's Archer Aviation, drone technology, Plug Power. I think they do the EV charging stations or software, something like that. And yeah, Monday.com, I think we went over it. I mean, obviously, I don't have the confidence to invest into them, but after seeing what happened to Atlassian, another tier 4 SaaS, hopefully Monday.com can have the same reaction. Look, between you and me, I don't want to see people losing money, okay? I know a lot of you tuning in, you're investing into Adobe, you're investing into some of these other tier 4 SaaS stocks. I want to see you guys win. I'm sick and tired of seeing the SaaS stocks getting punished. So I hope Monday.com rallies. And I mean it. Likewise, I hope Figma recovers as well. There's the Atlanta Braves. I didn't know that they were publicly traded. Now, here's something weird about me. I'm a huge sports guy. I usually have the camera turned on, and behind me, I don't know if you can call this a man cave. It's essentially like the family office where we get our work done. But anyways, I have flags of Tottenham Hotspurs and then the Seattle Seahawks. And I'm trying to get the Seattle Sounders up on here. I'm a huge fan of sports, but I just can't get into baseball, which is kind of crazy because when I was in middle school, I had the home run record. I was pretty talented in baseball. I don't know, it must be in my DNA. Something about Koreans, and I guess we can throw in Japanese as well. The Koreans and Japanese are just really good at baseball for some weird reason. But even as an adult, I just can't get into it. Now, what's really weird is there's a growing population of Indian Americans, and so cricket is becoming a thing, right? I was like, what, cricket? So when you think about some of the CEOs of the biggest companies in the US, they're Indian, right? Google, Microsoft, and some other companies. They're putting down a lot of money into making sure cricket can survive and become viable for the US. So you look out at the stands, you would imagine, oh, is it going to be a diverse mix of an audience? No, it's usually like other Indian Americans or immigrants. I tuned into their championship match and I was like, dude, it's actually kind of cool. I know, I would have never have said that in a million years. I'm like, what, cricket? Low-key cricket looks fun. Baseball, I just can't get into it. Another fun fact is Manchester United, they're actually a publicly traded stock. Now, here's the thing. Even if the Seattle Seahawks, actually that's a lie. But when it comes to sports teams, I just feel like it's a very difficult, low-margin business operation. The P&L is very difficult to execute because the players, their contracts, dude, it's bonkers. $200 million, $250 million. And the revenue that you bring in, it's razor thin, right? From ticket sales, jersey sales. They're usually just barely getting by. And so the whole idea of investing into a sports franchise makes me uncomfortable. But having said that, dude, if I was like 6'5", 300 pounds, and I was an offensive lineman, dude, I would pray to get drafted by the Seattle Seahawks. I think when it comes to the NFL teams, there are no other franchises that are just... well, hold on. I think the Green Bay Packers have a pretty well-run operation as well. So maybe the Packers, but most definitely the Seahawks, that's who I would want to be drafted by because the operations are so well ran. Beautiful. And I'm not just saying that because I'm a fan of them, but if you think about it in comparison to the Cleveland Browns or the New York Jets, terrible. And not just because of their wins and losses, but their leadership, their facilities, just the way that they execute is trash. Now, having said that, I do think Cleveland Browns this upcoming season, look, I think they have a top 5 defense, and I think their offense improved by a significant margin through this year's draft. So I think they have a top 20 offense as well. So I do think they can be a 9 or 10 win team. But anyways, nobody gives a crap, man. Dude, I'm from Sweden. I'm from Singapore. I'm from Japan. I don't care about the NFL. Stop talking about that. Talk about stocks, you monkey. That's what some people comment. So we'll go back to the video. But I think that's about it for Monday. Let's hop on over to Tuesday. 182 companies reporting. We have C Limited. The expectations are pretty mighty. 34% increase in their revenue, 16% in their bottom line per share. And then there's Franco-Nevada. Now, this is a very interesting one. Hear me out. I'm not invested into them, by the way. I just think it's interesting, okay? It's a financing company for metal mining projects. So think about them as a bank that hands out loans to people that want to mine metals. Isn't that kind of interesting? So instead of going to a bank, a precious metal miner would just go to Franco-Nevada. I think that's like a That's a really interesting operation. I guarantee you've never heard of them. But look at their expectations and their numbers. A 72% increase in their top line, which is their gross sales, a 95% increase in their bottom line. So there's a lot baked in. The expectations for this company, I think for them to, here, let's click and find out what's their trading multiple. Their PE ratio is a 40. And it makes a lot of sense because the numbers that they're executing are pretty impressive. Take a look at their performance for the past 1 year, 36%, past 5 years, 56%. It's pretty good. Take a look at their P&L. My goodness, their revenue for the trailing 12 months has increased by 64%. It's pretty amazing. Their dividend growth is 8%, payout ratio is 27%. This is a company that I want to do a deeper dive on, but I'll tell you this. So when the companies take out loans from Franco-Nevada, instead of just paying back whatever it is that they borrowed, Franco-Nevada, this is what they want instead. They usually get a cut of the revenue of the metal or whatever it is that they're mining forever. So it's usually like 1, 2, or 3%. Pretty crazy, right? So when you think about Franco-Nevada, that means they don't have to spend a dime on labor costs of like various miners, all of the extracting equipment, fuel costs, capex, or any of the other headaches associated to win from the gold and silver rush, and especially with the rare earth metals. So that's a name to definitely put on your watch list because I'm putting it on mine. Franco-Nevada, ticker symbol FNV. And then continuing on, Tuesday, JD.com. We also have Tencent Music, Oklo on, which for the numbers that they're executing, let's take a look at this. Their top line increasing by 30%, and yet their stock price is just getting hammered, right? Let's do past 3 months, negative 19%, year to date, negative 25%. So on holding, they basically sell the shoes that kind of look like Nike Shocks, back from the 90s, early 2000s. I don't get what all the hype is, but apparently that's all the fad and the trend. And you guys already know my opinion about apparel retail. I personally wouldn't want to invest into any of them because you really don't know when their time to shine is over, when the curtains get pulled on them. But taking a look at the numbers that they're pulling off and their stock performance, it's almost a scandal. It's diabolical. Because when you're pulling off 30% growth in your gross sales and then your free cash flow went down. Okay, 37%. Okay, so maybe it's a hit or miss with the numbers, but still, when the revenue is growing by 30% and your stock price to be down and getting punished, it's like, golly, man, that's a tough one to swallow. So me personally, I don't care about On. I don't care about Adidas. I don't care about Gap. I don't care about Levi's. I think money can be made, especially if you time it right. If you see a trend blowing up on social media, every kid wants to wear Crocs in 2019 and you invest into Crocs, I think you could have made a lot of money when they ballooned up to $200 whatever a share. But you got to time it perfectly with apparel retail. Because just as fast and as quickly as they go up, they come crashing down. However, with that said, with Nike, because I don't want to be a hypocrite, I have been watching them, I have been monitoring them, because not so much of them as a brand of clothes, right, where they're fighting with Lululemon and Alo, but more so because I think they're just one fad or one trend away from being relevant again. Right now, you go to Ross, you go to Marshalls, you go to TJ Maxx, dude, it's probably full of Nike, which is outrageous because I remember back in the day when Nike was the hot choice of clothing for athletes, I would go to Ross just begging to find anything Nike and you can never find Nike, right? Same with Marshalls and TJ Maxx. But when I went back to the States to do a tour with the families when the wife was pregnant, I went to Marshalls, TJ Maxx, and Ross. It was just filled with Nike. Nike has just lost its place with its core audience base, the sneakerheads. Just nobody wants to wear Nike anymore. But having said that, I think with their history, I think with their R&D, I think they're just one trend, fad, or product away from being a huge hit again. However, at 40 whatever dollars a share, and their trading multiple being outrageous, I think it's like 35 or something like that, I'm not looking to get in. But I think once their PE ratio gets closer to a 20, a 19, or an 18, stock price being around $20, $21, I'd be interested. I'm not even going to lie to you. At that point, I think the risk to reward, I think the floor at $20 a share for Nike, I'm not going to say it's going to go any lower, but I feel like the ceiling, like the reward would be a lot higher than the downside and the punishment of them going down to $10. Then again, they could. You never know. You really don't know when it comes to apparel retail stocks. And I've witnessed it myself with Abercrombie, Under Armour. Like, you see them going to the moon during one season, and then the next season I follow up on them, and then bam, they're down 80%. It's like, what in the hemoglobin is going on? So with Nike, I am watching them. Just because I feel like if you compare them to a I don't know, like a startup, athleisure, or sneaker brand that does not have a world-renowned research laboratory in Oregon with scientists trying to manufacture the best running shoes, there is a value add and a differentiator and an economic moat associated with that, right? So I just feel like they're one product away, just like Eli Lilly, just like Novo Nordisk, right? Isn't it weird that apparel retail has parallels to the pharmaceutical space? They're just one drug, vaccine, or product away from soaring. And that's how I feel about Nike. Now, having said that, I do not think Nike's a good deal right now, but if their stock goes lower and lower, I will be interested. I'm not even going to lie to you. It almost comes to a point where, like, so earlier this year, I made a 35% profit on Target, right? I don't believe in Target's leadership. It's not even my preferred place to shop, right? I prefer Costco or Sam's Club myself. And then for grocery shopping, I usually prefer like Albertsons or Ralph's or something like that, right? Safeway. But what I have learned is when it comes to blue chip household names that have a dividend track record of like 30, 40, 50 years of paying and growing the dividend, and them being a name that's associated with almost every household, it's almost a matter of time before they rebound. And so when they drop down to 80 something dollars a share, I went in pretty big. And then I sold out of them, and I have no regrets, and I would do it again. And that's the same mindset that I have with Nike. Just like with Target, I don't see them as being a buy and hold, but I do see when the opportunity presents itself where the valuation makes 0 sense, where the trading multiple is historically too low in comparison to their own timeline. Like for Target, when I bought into them, I think their PE ratio was like an 8 or 9, which from my understanding, if a PE ratio is a 6, 7, or 8, the markets basically price you for death. So if you look up Western Union, their PE ratio is around that number as well. When it's a single digit number for me, and when I thought about Target, I was like, absolutely not. I'm buying in. And that's the same framework that I'm bringing with Nike. So let's see what else we have. Oh my gosh, speak of the devil. There's Under Armour reporting as well. But I'm not interested in them. And I think that's because they don't pay a dividend. I feel like, for me, I'm willing to take more of a risk on you, especially if you have a sustainable and a healthy dividend profile. Because if I buy into you and you dip a little further, it turns into oh well, I guess I'll have to just hold on a little longer. But in the meantime, I'll be collecting rent from you in my portfolio. But if I buy into you and you don't pay a dividend, That's like what I said in the beginning of the video. And you go down 20, 30%, I have nothing to show for it. You're just going to be an eyesore in my portfolio where you're just rotting. And I got to wait for you to break even and then go back into the green or bounce 10, 20%, and then I'll cut you. But with a dividend paying stock, it's like it reduces the severity of the hurt in my heart. Because if I buy into you, because I trust you of like, okay, I think the valuation's good, it's a high quality business, I think the risk to reward, I think the margin of safety, everything makes sense, and you dip 10% or 20% into the red, but you're still paying a pretty fat, juicy dividend that's sustainable and it's healthy, then I'm like, you know what? At least I don't hate you. But with growth stocks, and I say that with parentheses in the front and the back, doesn't necessarily mean that they're going to grow. So, with Under Armour, do you see how it's a different tone? With Nike, they've got a pretty good dividend and a history to back it up. My only concern is with Nike's dividend, I don't think it's healthy. I don't think it's sustainable. You take a look at their net income per share or their free cash flow per share or whatever, you look at it, it is not sustainable. They're going to have to cut that dividend unless the stock price can recover and their EPS goes higher and higher. But anyways, we'll see what happens, right? And as we scroll down and take a look at what else we've got. Black Rock Coffee Bar. I've never heard of this company and we're going to stop looking. I think anything less than $1 billion market cap, I truly don't even contemplate. Because the volatility for me, with my risk tolerance, I just don't want to entertain you. I like to have a little bit more stability. And even if you do have a big market cap, it does not mean that you can't see 20% gains in a single trading day. Hi, I'm talking to you, AMD and Micron. Because even if you still have a $200, $500, $900 billion market cap, you could still fly to the moon. Because usually people invest into small caps to see that kind of swing behavior, right? The smaller the company, the bigger the fluctuations. But if it's a pretty good business and they're at the tip of the spear of whatever movement that they're associated with, they can also see the exact same fluctuations as the small caps. To the flip side, to the good side, to the upside, by the way. Now, having said that, with the small caps, it's a lot more common if they have a really piss poor report for them to drop, I'm not exaggerating, 50, 60, 80% on a single trading day. Whereas for a large cap company, usually the worst I've seen is like 20, 25%. And then by the end of the next following week, it usually recovers and they're probably only like negative 10%. And given time, they're break even, usually how it pans out, but not all the time. But on Wednesday, it gets a little more interesting. We have Cisco, which I really do like them, right? Because I guess they do have a little exposure to cybersecurity, but I think anybody that's doing the physical infrastructure of IT equipment for the data centers, for me, I feel more comfortable rather than the ones, I guess, fighting tooth and nail to be the next chip. Because like with that, it's so cutthroat, but also the risk to reward is a lot higher, right? I mean, when you think about Marvell, which was a stock research that I gave to the Patreon community, I mean, Marvell has just been crushing, especially with Broadcom as well. But me personally, I would rather go with the picks and shovels and axes rather than the chips, because the chips, yeah. And to take it a step further, I would rather go with the wagons, such as Lam Research or Applied Materials, than going with the chips. Because with the chips, it's just there's so much uncertainty in the air, especially with big tech making stuff in-house or a newcomer coming or China. There's just too many variables with chips where it's just, they're all supporting the same AI movement, or I guess some people would say the AI bubble, but it boils down to which one has the most risk baked in. But with risk, there's also reward, right? So it's a double-edged sword. what you're willing to tolerate. And let's see. There's Honda Motor. I think I said a lot about Honda the other Compounder's Corner episode. It's a company that I did consider, but after my analysis, I decided no. I know this is crazy because I personally, I wouldn't want to invest in a Chinese company, but after getting to know the vehicle landscape, if I had to invest, I would boil it down to two. It would either be Ford Motor because of the US government's involvement, but also their support in not letting Ford fail. And then the second path, it would be the Chinese EVs. Look, I think once the Chinese EVs get rolled out, GTM in the US market, you guys are going to see quickly that when you can buy a car that's almost the same as Tesla without the best software, obviously, but the same battery range, 250 miles, for a fraction of the cost, 12, 14, 15 grand. When we talk about BYD, when we talk about NIO, when we talk about Xiaomi, I'm telling you guys, the Japanese vehicles like Toyota, Mazda, Honda, dude, they're so screwed. It's the exact same thing that happened in the 80s when the Japanese cars came over to the US. They just demolished the North American auto sales, right? Because I think we quickly realized, why buy an American car that's going to break down or the transmission going bad on you when you can just buy a Toyota or a Honda? Likewise, the value proposition, especially with the price, and especially with how much they have advanced in their capabilities. Why? Because almost everybody was utilizing China to manufacture stuff for them. So they have years of experience manufacturing goods to the point where now when they produce their own in-house goods, I'm not going to say it's going to be better than the European or American products, but dang, they're getting up there. And especially when it's only a fraction of the cost. So all that to say, if I had to invest into auto stocks, it would be Ford, potentially GM, or the Chinese EVs. Now, having said that, I don't want to invest into the auto stocks, okay? But if I had to. But Honda Motor, for me, I think the path forward for them is going to be pretty rough. And that's why in the past few weeks, the Asian, European, and American automakers have been jumping up and down and screaming that we cannot allow Chinese EVs to enter the US market because the US market is the biggest money potential for the cars. And that's why they're trying to protect it at all costs, and that's why Chinese EVs aren't allowed. I mean, you can import one in, but you got to pay, what is it? Something ridiculous, like 100% tariffs, but it's not mainstream. But once those Chinese cars arrive, I mean, there are some people doing it through a backdoor method of getting it into Canada and then driving it down to the US. Obviously, you could do it that way, but if you're a family from South Carolina or Arizona or Texas, you're not going to go through the trouble of doing that. But once it happens and we start having BYD car dealerships, especially in Albuquerque, especially in Tampa, especially in Cincinnati, dude, it's game over. I'm not even trying to be like a sensationalist or be exaggerative, but I'm being serious. Hyundai, Kia, Jeep, dude, y'all are screwed. Then, of course, anything can happen, so I don't know. And then, let's see, there's Birkenstock. They're in the business of making those clogs and slides, which, again, I wouldn't invest into them, okay? And then there's USA Rare Earth, which kind of like how I was talking about Franco-Nevada, I want to talk about them for a little bit, okay? It's kind of like MP Materials, which is a company that we did a deep dive on this channel not too long ago, in that they do rare earth mining. Because believe it or not, those metals are used for a huge array of different products. And right now we depend on China for almost all of it. And so the US is trying to deviate away their dependence on China, because it's going to get to a point where China is going to be able to use those metals as a bargaining or negotiating tactic, right? And so the name of the game for the US is to try to get it in-house in places like Texas or Nevada. But with the USA rare earth, it's still in the early stages. So if I had to pick, I would rather go with MP Materials because they're scaling. Whereas with USA rare earth, I think they just became a revenue generating company, meaning up until this year, they weren't making money, pre-revenue. And then as we scroll down, let's see. I'm going to be honest, for Wednesday, there's nothing else really worth calling out. So let's jump on over to Thursday, Applied Materials, and then there's Brookfield. I want to talk about this for a bit. So it's a giant conglomerate that makes money in many different ways. Utilities, energy projects, you name it, they do it. To the point where they have multiple different publicly traded tickers. Now, Brookfield Corporation would be my number 2 pick if I wanted to invest into Brookfield. My number 1 would actually be BAM, Brookfield Asset Management. And it's the arm of the business that makes money from fees in order to invest your capital. So when we think about pension funds, insurance companies, and other parties, I do like them. However, I don't think they're at a good valuation yet. So with Brookfield, after they report their earnings on Thursday, for selfish reasons, I do hope they sell off because they're getting close. They're getting close to my entry price point, but it's not exactly where I'm so desperate to pay for them for what they are right now. And then there's New Holdings. Now, this is a company where they just take a look at this, guys. Like, this one kind of blows my mind. So their revenue growth is 27% year over year, which is pretty impressive. Bottom line per share growth is 45% year over year. Now, free cash flow is going to be pretty good because it's a fintech finance, cash transferring type of business, kind of like PayPal, kind of like SoFi, all in one. Free cash flow is actually negative. Okay, my gosh. But anyways, their books, $16 billion of cash. What about their loans? Should be high, $5.2 billion. So their net cash position is $11 billion after taking care of all of the loans on the books. It's pretty good. So you would think a company like that, right? Obviously negative free cash flow, but they have a chokehold, nearly a monopoly in Latin America, right? Brazil, Mexico, Colombia, Peru, Argentina, they crush. Their stock, the past 3 months, negative 21%, past 6 months, negative 13%. They're selling off pretty hard, but that's not unique just to them. Because even on the American side of the house, SoFi, PayPal, everyone that's in the business of fintech and payment processing and transferring cash from one place to another, everyone's selling off pretty hard. So it's not unique just to New Holdings, but I will say this. If it wasn't for their negative free cash flow situation, this is one that I would consider, I guess, prioritize in my watch list, but I would have to do a deeper dive to figure out what is going on with their free cash flow situation and why is it so bad. And then there's also Copart. I think there's a lot of hype surrounding this one because of one person. I don't know who it is. I seriously don't know. One person got the genius idea of pumping this one. I don't know if it was on stock tweets, Reddit, or somewhere. And then everyone else started looking at it in a more closer fashion. And after looking into them myself, I was like, I don't know what you guys see in it. So Copart's in the business of selling salvaged, titled vehicles that are totaled, vehicles that are just trash at auctions. Now, fundamentally, there's a business to be made in that because if you want to buy a replacement windshield or replace your car seat, you either got to go through a junkyard or you got to go through a dealer that buys these cars so you can part it out, right? So I do think money can be made there, but as an investment, guys, just think about it fundamentally. Like, does that sound like a lucrative, like, what's the growth catalyst? I can kind of see it in a sense where with the used car prices being the way that they are, ridiculous and a ripoff and a scam, right? Because I think I told you guys that's one of my first priority big ticket purchases. We need to buy a family car because we're going back to the US. It pisses me off when I see a car with 300,000 miles on the odometer selling for 10, 15 grand. Like, it just pisses me off. But one of you put me on, and I started looking at cars from the surrounding area, like South Carolina, and it's a fraction of the cost with less miles. I'm not joking. So, like, one car that I'm trying to get is a Honda Odyssey, which is a minivan. We've got a growing family. So in my region where we're moving to, it's around 10 to 12 grand for 300,000 miles. That's a car that's just asking for you to take them into the repair shop. I don't give a crap if it says Honda or Toyota. It doesn't mean it's indestructible. It doesn't mean that's invincible from leaks, from the pure age of wear and tear. You're going to have oil leaks. You're going to have to do a crap ton of maintenance. I'm sure that the brake pads, the rotors, everything is rusted, right? So it pisses me off when they're asking for 12 grand. But anyways, looking at places like South Carolina, North Carolina, or Tennessee, the exact same Honda Odysseys are going for like 1,500 for 300,000 miles, which I'm personally never going to buy a car that has more than 150,000, maybe 160. Like, when you're a jerk off trying to sell 300,000 miles on the odometer for 12 grand, dude, you are not invited to the potluck. But having said that, in South Carolina, I did find some Honda Odysseys with like 110, 150,000 miles on the odometer for like 5-6 grand. So now I'm at the point where I'm like, maybe I should book a short little flight by myself. I don't know, like a 60-minute flight, fly on over there, buy the darn car, and drive it back down. That's where my head is at, because that would save like 3, 4, 5 grand. But anyways, because the used car market is so messed up, I think more and more Americans are hanging on to their cars for dear life instead of the usual after 3 to 5 years trading it in for something new because you're just sick of looking at it, which kind of blows my mind. I feel like if a car is running and it's fine and dandy and it gets you from point A to point B, why just get rid of it? But then again, I know there are some professions where your looks, your appearance, it matters, especially when you're trying to seal the deal, or, you know what I'm trying to say, your reputation, your physical appearance matters. Now, me, I don't really give a darn what people think of me, but I think if you're a lawyer, if you are a salesman, if you're in the business of real estate, or you're an executive at a business operation, of course you're not going to be driving a 40-year-old raggedy-daggedy car that's breaking down. Of course you're going to be wanting to drive one of the latest and the greatest, because appearance does matter in those social circles. It kind of sucks to admit, because I've literally broken bread with executives at some of the biggest companies, and I know it really matters. The way that your smile looks, your presentation, the way that you sit, all of that matters. I hate that crap. I can't stand it. Because I'm all about just being real, just being raw, and just being authentic. But in certain professions, you got to play the part. And so I understand. But for most Americans, you know what I'm saying? If you're blue collar, if you're an entrepreneur, if you're just, I don't know, if you work at a gas station, you have no business driving a 2026 Scat Pack or a Dodge Ram pickup for 80 grand and your monthly car note being 1,600. Doesn't make any sense. You should just drive, I don't know, like a reliable Ford Crown Victoria, or what's another pretty reliable car? Like a Honda Accord, something like that, right? But having said that, as people are holding on to their cars longer, I think they're doing more repairs and maintenance in order to keep it alive. And that's why I see the bullish sentiment with like Advance Auto Parts, O'Reilly's, and some of the other, I guess, retail stores where you can get car parts. Like, I get it. But with Copart, they're not in the business of selling turnkey cars. I think they do have some in their inventory, but it's mostly cars that have been in accidents where the airbags have deployed. It's cars that are lemons. It's cars that are just ruined. But then again, I guess it makes sense as people need to source replacements for things that break down in their own car, like the shift knob, seat belts, and headrests or side mirrors. So I guess it kind of makes sense, but it's not one that I would feel bullish on. I would personally just invest into Advance Auto Parts or O'Reilly's or hold on, what are some of the other ones? Right, so you have AutoZone, Advance Auto Parts, O'Reilly, Napa, and even Amazon. We can throw them into the mix. I'd rather go with them than Copart, an auction-based inventory of salvaged cars. Yeah, maybe I'm missing the point. Because I only spent like 30 minutes researching Copart before I concluded I don't want to do it anymore because I just don't see the point. Like, when you're putting money into a stock, don't just think of it as a ticker, right? Think of it as a business operation where you become an owner. Like, would you feel comfortable sleeping at night knowing you own a car auction site that sells broken down cars? Look, I'm not here to judge, but it's like, I just don't see it. Like, where's the light in that? I'd rather buy Carvana, as crazy as that sounds, or CarMax than Copart. I don't know, guys. I'm missing the point. Please put me on. I just don't get the bull case for Copart. There's Figma. There's Bullish. There's Intuitive Machines. There's Boot Barn, which... remember what I said about apparel retail, right? They go in cycles. They have highs and lows. Yeah, check out what's happening to Boot Barn. Take a look at this. The past 1 year, 45% into the green. Past 5 years, 118% into the green. And I think it's because, now hear me out. I'm over here in Japan, but based on what I have been seeing on social media, I think there's a resurgence, a renaissance of folks trying to be more cowboy and western again, and even country music is making a comeback. I'm not kidding. And so Boot Barn, it's one of the apparel stores where you can go to get like a Texas style footwear, boots. And so I'm not surprised that they're crushing. Their financials are ridiculously good. All that to say, it's only a matter of time before folks realize I don't want to dress up like a cowboy anymore. And then Boot Barn's going to go 40, 50, 80% into the red, which, speaking of which, one of my buddies used to be a product manager at Boot Barn. It's kind of funny to see their stock be crushing for the past 5 years. And then there's York Space Systems. And let's see, there's Fermi, there's Rumble. There's actually a lot of companies reporting on Thursday. TMC, the metals company. And there's another shoe retail apparel company, Wolverine Worldwide. This is one of the companies that when I took accounting, we had to dissect all of their financials, look at all of their books, their 10K, to figure out how to analyze a company. Wolverine Worldwide, believe it or not, they're the parent company of so many brands that used to be popular. The key word being used to. But I think they also backtrack on their mistakes and they do divestitures pretty often. But at one point, they were the parent company of Sperry's. I don't know about you, but going to high school in 2006, 2007, whatnot, Sperry's, all the rage back then. Keds, Sebago, they also sell Chacos, Hush Puppies. And these two brands I agree with. They're pretty hot right now, especially in the fashion crowd. Morel and Saucony. And Saucony is there for running, and Morel is for hiking, but people wear them as fashion shoes instead of Nike, which is kind of crazy to say. Now, I pursued my MBA in 2019, so it's been quite a handful of years, but my takeaway back then was Wolverine Worldwide is a very average company. It was a C tier. And I think the professor intentionally picked them because there's nothing crazy about them, nor nothing horrific about them. It's like middle of the road. So when I think about a very average company, I think about Wolverine Worldwide. And that's the conclusion that I still have to this day, especially just glancing at their P&L. It's not pretty. I think a case could be made that it's kind of ugly, but the efficiency of it is probably more important. Oh gosh, I would have to put them into the D tier. I think after 2019, things went pretty south for this company, especially during the pandemic. I would have to look at their numbers in a more deeper format, but I think D tier would be more fair for them. But anyways, let's take a look at what else is on Thursday. Canada, Alto. And yeah, we're in the small caps. I don't want to mess around with that. Let's jump on over to Friday. There's Mitsubishi, Brady. Anything that sticks out? There's a company publicly traded as Ding Dong, and I'm not exaggerating. Ticker symbol DDL. Anyways, before I head out of here, is anyone else having a slight diagnosis of FOMO? The fear of missing out from watching what's happening to some of the semiconductor chip stocks like AMD, or the SSD and RAM makers like SanDisk and Micron. I am not kidding. Like if we just pull up Micron, the past, so when the stock market closed on Friday, their stock price went up 15%. And the past 1 week, 38%. Year to date, 161%. Past 6 months, 200%. So my goodness gracious. And I think what makes all of this outrageous, friends and family, is that their forward PE, predicated upon next year's EPS, is an 8. So you would think even after their stock price rallying beyond a point where things make sense, their valuation is still not half bad. For the past 365 days, they're in the green, 804%. I mean, if we're going to be honest with one another, gosh, if I just put $1,000 into them a year ago, golly, right? 10 grand. Had I just put anything into them? And that's the thing I always get upset about. I'm like, when you think about the data center boom, I mean, I think we all thought about the utilities helping to power all of their energy needs. I think we all thought about applied materials and land research. You can't really make the chips without the equipment that makes the chips. I think we thought about the applications, right? Meta, Microsoft. But how the heck did we not think to invest into RAM, into memory, into SSD? Obviously you can't have servers running unless you have RAM. Why did I not think of investing into them in 2024 when they were $100 a share or $70 a share? I don't know. I will say this though. I'm too scared to jump into them right now, especially after looking at their stock price movement, because when something goes up this quickly and in this aggressive fashion, I just feel like they're also going to crash pretty hard from people taking profits. Can you imagine if you buy in and your cost basis is $750 and they sell down to $450 to kind of reset their valuation, even though I think their valuation is cheap based on next year's EPS being an 8? I think that's really cheap. But it could happen, right? It would not be a good feeling. But speaking of FOMO, what's the opposite emotion called? Because rather than dwelling on this regret of not buying into Micron or SanDisk or Seagate, just the other day, I sold out of all of my military stocks because I felt like they were at the top of their cycle. Because exactly like Micron, here's what we're seeing. When we jump back 1 year with Huntington Ingalls, they basically make all the ships for the US Navy and Coast Guard. You take a look at their price action, they were roughly like $200 about a year. Let's zoom out 5 years. So in 2025, they were like 161 a share, and then they skyrocketed to 450 a share, right? 160 to 450. And I was like, dude, I just feel like I understand that there's conflicts happening all around the world, but for this stock to skyrocket like that, it doesn't make any sense. I just had that gut feeling that they were at the top of their cycle, so I sold out. And looking at the military stocks now, Huntington Ingalls, they're just going straight down, right? A nosedive. Some of my other positions, like Lockheed Martin, exhibited the same exact thing, went all the way up, and they're just crashing hard. So I'm really glad that I sold them when I did, which it's a lesson that I learned the hard way a long time ago, which is to buy and hold and do nothing. I think buy and hold is good wisdom, but to do nothing aspect, I think that's where I don't feel comfortable with. I think it's okay to sell for a profit and walk away in the green. Never beat yourself up for that. Green is green. But also it's okay to sell, especially if you think things are not normal and it seems a little bonkers and a little crazy and a little chaotic, where the valuation went up way too fast, where you'll feel like it's not going to be sustainable, and it's okay to seize the gains. Or if the investing thesis changes, that's okay to sell there too. But to do nothing, had I bought into Lockheed Martin, I don't know, a year ago at freaking, like $4.75 a share, and now they're $500 a share, I would basically be in the green by only a small margin, right? Like 7% gain. But because I sold them at the top, I walked away as a happy camper. So, I don't know. In one aspect, I'm sad that I did not invest into Micron and SanDisk. But on the other hand, I think I'm doing okay. All that to say, I love you guys. Stay safe, especially with the Hanta virus progressing and everything. Wash your hands. Good luck in the stock market, and I will talk to you guys next time. And hopefully I don't get sick this week, because it is on my agenda to upload more videos, especially about the water infrastructure landscape and some other stuff. Okay, see ya!